So, hello and welcome to another interesting episode of Knowledge Sharing brought to you by the WealthBridge team. We at WealthBridge are committed to be your knowledge partner and help you to a long and lucrative investing and compounding journey. Today, we are going to speak about a very important technical tool which is called the 50 DMA or the 50-day moving average. This is a commonly used technical analysis indicator in the financial markets for tracking and monitoring the prices of securities. In the recent past, in stock trading, it has become a key indicator to understand many things about the stock prices, the patterns, and the interpretations. A 50 DMA represents the average closing price of a security or financial instrument over the past 50 trading days. Computation. How does it get computed? To compute the 50-day moving average, you can add up the closing prices of the stock for the past 50 days, divide the sum by 50. As each new trading day's closing price is added, the oldest price that the 51st day ago is dropped from the calculation. This process creates a moving average that is continuously adjusted to reflect the recent price action. This is plotted as a line on the chart where the moving stock prices are plotted day in, day out, and hence it acts as a reference point. The 50 DMA is considered a medium term trend level for monitoring. This means that from a 3 to 6 month perspective, for analyzing the stock price action, if the prices are above this line, the trend is considered as up, and if the 50 DMA is breached or the stock price line goes below that, we can assume that a medium term trend may have ended. Similarly, the 20 DMA and 200 DMA are other popular moving averages that are used. 50 DMA is the shorter version of the 50 DMA, and the 200 DMA is the longer version. It's called a long term uptrend or a downtrend. When we break this line and trade below it, we assume that the long term uptrend has been broken and now we are in a long term downtrend. However, it is essential to use this particular tool in conjunction with some other key indicators and analytical techniques for informed decision making. Trend identification. What is a trend? You would have heard the saying many times, follow the trend. But what is this trend and how do we know what is the trend? The 50-day moving average is used to identify the direction of the prevailing trend in the price of a stock. If the current price is above the 50-day moving average, it is often interpreted as a bullish signal, suggesting that the price trend is upwards. Conversely, if the price is below the 50-day moving average, it may indicate a bearish trend. Support and resistance. This is one of the key important facets of a 50-day moving average looked at in conjunction with the stock price. The 50-day moving average can act as a support or a resistance level. What does this mean? In an uptrend, the 50-day moving average may act as a support level, meaning that the price of the stock can come down, touch this line, and bounce off, that is, go upwards. So the upward trend has continued. Conversely, in a downtrend, the 50-day moving average may act as a resistance level, preventing the price from rising above it. Hence, every time the price rises there, it comes down, and hence it is a resistance to going up. Trading signals. Crossovers between a 50-day moving average and the securities price can generate trading signals of both types. A bullish signal occurs when the price crosses the 50-day moving average, suggesting a potential upward trend. Conversely, a bearish signal is given when the price crosses below the 50-day moving average, indicating a potential downtrend. Overall, the 50-day moving average is a widely used tool by traders and investors to analyze trends, identify potential entry or exit points, and manage their risk in the financial markets. However, it's essential to use it in conjunction with other indicators and analysis techniques for more informed decision making. Let's look at this chart of CNX 500 diffusion versus the CNX 500 price action. We can clearly see that the diffusion chart shows the percentage of stocks in the index trading above a specific moving average. So in the chart above, the lower half, the green line, is moving up and down in a range. The range represents 0 to 100%, which is the percentage of stocks in the CNX 500 index which are above the 50-day moving average. The higher the ratio it represents, bullishness in the overall index and its participants, and a lower number indicates weakness or bearishness. As we can see, the current line is at 21%, which means that only 21% of the stocks in the Nifty 500 are above the DMA, which is a sign of weakness. But as is seen usually, these are good points of reversals since they represent a highly oversold sentiment in the market, which means many participants have sold their positions and would be waiting for a buy signal. You must have heard the favorite adage buy the fear and sell the greed. So the sentiment here is extreme fear, and hence this is likely to be a reversal point, which means it is likely that with such a low buying position, the participants who are not participating or sitting on the sidelines after selling would start buying back, and a buying strength is likely to come back into the market. So this is all we have, a short and crisp understanding of the 50-day moving average, the trend that it helps us to spot, the decision making and the likely actions that we can take in conjunction when used with the other technical indicators. Thank you and have a great investing week ahead.